If you invested $10,000 and just matched the S&P 500 over the last 30 years, you'd have over $200,000 today. #7. Trying to time the market. Problem: jumping in and out of the market trying to buy the exact bottom and sell the exact top. Why it matters: nobody, not fund managers, not analysts, not you, can consistently predict short-term market moves. Missing just the market's 10 best days over 20 years can cut your total return in half. Real example: an investor who stayed fully invested in the S&P 500 from 2003 to 2023 significantly outperformed one who missed only the 10 best trading days in that span, even though both were invested almost the entire time. Step-by-step solution. 1. Use dollar and cost averaging. Invest a fixed amount on a fixed schedule, regardless of price. 2. Automate your contributions so emotion never makes the decision. 3. Accept that time in the market beats timing the market. Common mistake: waiting for the perfect entry point that never comes and staying in cash for years while the market climbs without you. #6. Not diversifying. Problem: putting most or all of your money into one stock, one sector, or one hot tip. Why it matters: concentration can make you rich fast, but it can also wipe you out fast. A single company can drop 50 to 90% on bad news. A diversified portfolio absorbs the hit. Real example: employees who held large amounts of company stock at firms like Enron or Lehman Brothers didn't just lose their jobs. Many lost their retirement savings in the same event because their investments and income were tied to the same failing company. Step-by-step solution. 1. Spread investments across asset classes: stocks, bonds, index funds, real estate. 2. Use broad index funds as a core holding before picking individual stocks. 3. Cap any single stock position at a small percentage of your total portfolio. Common mistake: confusing "I really believe in this company" with "this is a safe amount to bet on it." #5. Panic selling during downturns. Problem: selling investments the moment the market drops, locking in losses that would have recovered. Why it matters: markets have historically recovered from every downturn, but only for investors who stayed invested. Selling in a panic turns a temporary paper loss into a permanent real one. Real example: investors who sold everything during the 2020 COVID crash locked in losses of 30% plus, while those who held on saw the market fully recover within about 6 months. Step-by-step solution. 1. Before investing, decide your strategy in advance. Write it down. 2. Keep an emergency fund separate from investments so you're never forced to sell at a bad time. 3. When markets drop, review your goals, not the news headlines. Common mistake: checking your portfolio daily during a downturn. The more you look, the more likely you are to panic. #4. Ignoring fees. Problem: overlooking management fees, fund expense ratios, and trading costs because they seem small. Why it matters: a 1% annual fee sounds tiny, but compounded over 30 years, it can eat over a quarter of your total returns. Real example: $100,000 invested for 30 years at 7% growth with a 0.1% fee grows to roughly $761,000. The same investment with a 1.5% fee grows to only about $493,000, a difference of over $260,000 just from fees. Step-by-step solution. 1. Check the expense ratio of every fund before investing. Aim for low-cost index funds. 2. Avoid frequent trading. Each trade can add hidden costs. 3. Compare fee structures annually, especially for managed accounts. Common mistake: assuming a higher fee automatically means better management. Often, it just means lower returns for you. #3. Investing without an emergency fund. Problem: putting every spare dollar into investments with zero cash cushion. Why it matters: without savings, a surprise expense forces you to sell investments at the worst possible time, often during a downturn when you can least afford to sell low. Real example: Someone who lost their job during a market downturn and had no emergency fund was forced to sell investments at a loss just to cover rent, turning a temporary dip into a permanent loss. Step-by-step solution. 1. Build 3 to 6 months of expenses in a separate, easily accessible savings account first. 2. Keep that fund in cash or a high-yield savings account, not invested in the market. 3. Only invest money you won't need for at least 3 to 5 years. Real example. Many retail investors who piled into meme stocks and speculative crypto tokens in 2021 based purely on online hype saw those assets lose 70 to 90% of their value within a year. Step-by-step solution. 1. Research any investment for yourself. Understand what the company or asset actually does. 2. Ask, would I still buy this if nobody online was talking about it? 3. Limit speculative investments to a small, clearly defined percentage of your portfolio, money you can afford to lose. Common mistake, FOMO investing, buying because you're afraid of missing out, not because you understand the investment. #1, not starting because you want to wait until you know more. Problem, delaying investing for years because you feel like you don't know enough yet, the mistake almost every beginner makes in their first month. Why it matters. Time in the market is the single biggest driver of long-term returns. Thanks to compound growth, waiting 10 extra years to start can cost you more than doubling your contributions later ever could. Real example, an investor who starts at 25, investing $300 a month until 35 and then stops, will typically end up with more money at retirement than someone who starts at 35 and invests $300 a month all the way until 65, purely because of the extra decade of compounding. Step-by-step solution. 1. Start with whatever amount you can, even $50 a month, in a low-cost index fund. 2. Learn as you go. You don't need to be an expert to begin. 3. Increase your contribution gradually as your income grows. Common mistake, treating "I need to learn everything first" as a reason to delay, when starting small and learning along the way builds both money and knowledge. Action plan. Here's your 3-step plan starting today. 1. Check your fees. Look up the expense ratio on every fund you currently hold. 2. Automate. Set up automatic, scheduled contributions so you're never tempted to time the market. 3. Build your buffer, then invest. Confirm you have 3 to 6 months of expenses saved before adding new money to the market. The biggest investing mistake isn't picking the wrong stock. It's letting emotion make decisions that logic should be making. If this helped, subscribe for more real talk money breakdowns and tell me in the comments, which one of these mistakes have you made?